Welcome to chapter 11. So in chapter 11, we're going to be learning how to measure living costs, okay? So what is the cost of living? It simply means what is the value of your currency. So for instance, in the US, we're earning dollars, but how do you know the value of the currency? You have to compare it in terms of what you're able to buy, right? So the value of the currency relates to the purchasing power of the currency, right? So if there's a lot of increase in price level, aka inflation over time, then that is going to make the currency to lose its value, because then the prices are unstable, increasing, and then there's less production and too much money chasing the few goods, and then that leads to inflation and then loss of purchasing power, okay? And then that reduces the living standard of the country. Okay, so we talked about GDP and we talked about GNP in the last topic. How about when you say per capita? What does per capita mean? Per capita without the L, okay? So this is not referring to capital infrastructure. So this per capita is referring to per person. So when you say GDP per person, basically all you're doing is the GDP value of all the current goods and services produced in that particular year legally divided by the population. So that is going to tell you, for instance, if you say the GDP of a country is about $100 billion, what does it mean for each individual in that country? So if you have a 100 billion, that's going to be 9 zeros divided by, so let's say you have about 10 million people. 100 billion, that is gonna be, let's say you have about 10 million people, and then you have $100 billion dollars as the GDP, right? So what that means is each person is worth roughly $10,000 on a yearly basis. Well, it's just a hypothetical example, right? But that means each person produced about $10,000 worth of goods, for that year. So GDP divided by population gives you the GDP per capita or per person, right? Same thing for GNP per capita. You just divide the GNP by the population. So that's that for GDP or GNP per capita. How about, we talked about real GDP. So real GDP accounts for inflation or changes in prices over time. And it's also closely related to what we call indexation. So indexation refers to when you account for inflation changes. Okay. All right. And there are different ways to calculate living standards, or the changes in prices. In the last chapter we looked at GDP deflator, and this chapter we're going to look at using CPI to calculate changes in price over time. So what is CPI? CPI means consumer price index, and it's measuring the changes in the basket of goods bought by consumers in any given time. So usually CPI is on a monthly basis, and it's published by the Bureau of Labor Statistics in the United States, okay? So this is usually on a monthly basis, but it could also be aggregated to a yearly basis or a quarterly basis, or all of that stuff. So the major assumption for CPI is it assumes a fixed basket of goods and services, okay? So you have fixed basket of goods and services, and what does that mean? So it assumes that, I'm going to call goods and services G&S. It assumes that every consumer buys the same exact thing every month, which is just an assumption to make the calculation easier. It gives an estimate, but it doesn't give a perfect estimation, right? So because what you buy last month is not going to be exactly the same quantity or the same products that you buy this month. You might switch to like a substitute good or all of that stuff. So therefore, one of the disadvantages of CPI is that it doesn't account for substitution. So we call it the substitution bias. It doesn't account for the substitution of goods and services by the individuals, because it fixes the basket of goods and services that are consumed by people every month. So there's the substitution bias. How about the quality? There's also the quality bias, right? So for instance, even this marker, right, as at 10 years ago, the value of the marker is different, right? So the value has most likely improved compared to 10 years ago, if there was even a marker 10 years ago, right? So let's assume there was a marker 10 years ago. The quality has changed. So CPI doesn't, and when the quality changes, that reflects on the price. So most likely to get more expensive, the higher the quality. So that is not accounted for in the quality bias, the fact that affects the cost of production and that affects the price of the goods and services, right? Also, CPI doesn't account for the introduction of new goods and services, right? So every year there are new models of goods and services that come into the market. CPI doesn't account for that because it fixes the goods and services. So that kind of relates to substitution, right? So it assumes that there's no variety, which is, it causes bias in the measurement of the CPI. So because of that, people prefer to use GDP deflator for that calculation. Now, there is also something called core CPI. What is core CPI? So because of how frequently the prices of foodstuff and energy, meaning your gas and oil and all of that, because of how frequently those prices changes, they are very volatile. So the core CPI calculates the fixed basket of goods and services excluding food, and energy. Okay, so energy including your gas, your solar, all of that stuff. Okay, so it excludes it to give a more stable CPI value and a more stable inflation value. Okay, now what is PPI? PPI is the exact opposite of CPI. PPI means producer index, right? And this measures a fixed basket of goods bought by firms. So it measures the changes in the prices of fixed basket of goods bought by firms. Okay, and how about real interest rates? So the same way we have real GDP accounting for inflation. So basically your nominal, so remember your GDP deflator, is your nominal GDP divided by your real GDP times 100. In that same way, your real interest rate accounts for inflation, but instead of dividing your real GDP, if you exchange this, your real GDP is equal to nominal GDP divided by your GDP deflator, right? So, but instead of dividing for your interest rate, because interest rate is already in percent, so the reason we divide in GDP deflator is your GDP deflator is measured relative to the 100, right? So that's why you have to multiply by 100, you have to divide and then multiply by 100 to get a percentage value. But your interest rate is already in percent, right? So because of that, you don't need to divide for interest rate. So your real interest rate is just going to be your nominal interest rate minus your inflation. Okay, so these are basic concepts to understand. And let's take a quick example. How do you calculate the cost of baskets for goods and services? Still using our pizza and milkshake example, assuming these are the only two goods that exist in the economy, which is just an example, okay? But let's switch up the prices a little bit. How do we calculate the cost of basket? So remember that CPI assumes fixed basket, okay? Now let's assume that based on this fixed basket, we only have 10 pizzas that are demanded in total. Okay, let's just keep it simple. We have only 10 pizzas and 5 shirts, or actually 10 pizzas and 5 milkshakes demanded in total. All right, so you're going to take, for 2021, the price of pizza, $12 times how many pizzas were demanded? That's 10. Plus the price of milkshake, $18 times how many milkshakes demanded times 5. And that is going to give you $210 for 2021. For 2022, same concept, $14 times 10 pizzas. So again, someone is not going to keep demanding the same number of goods and services every month, but like this is just one of the flaws of CPI, okay? Plus $20 for milkshake times 5 milkshakes, still 5 milkshakes for 2022, okay? When you add it up, that is going to give you $240 for 2022. For 2023, $16 times the fixed 10 pizzas demanded and $22 times the fixed 5 milkshakes demanded, and that gives you $270. So this is how you calculate the cost of the basket of goods and services. Now that we found how to calculate the cost of the basket, to calculate the CPI is the same concept that we use in calculating the inflation using the GDP deflator. So basically the nominal basket divided by the real basket. So instead of having nominal GDP divided by real GDP, we're just going to have nominal basket divided by real basket. So let's quickly do that for 2021. And don't forget your times 100 because it has to be, the index has to be relative to 100. All right, so we have for 2021, 2010 divided by 2010. Again, there's no price change over there. So 2010 divided by 2010 times 100, right? That's going to give you 100, right? So no price change. But for 2022, we have 240, the nominal basket, divided by 210 times 100. And that's going to give you 114.3. Right? So, of course, this signifies an increase in price. How about for 2023? 270 divided by the previous year, which is going to be the base year, which is going to be 210 times 100. And that is going to give you 128.6 for that increase in price, right? So this is how you calculate the CPI. So this is the CPI for 2021, 2022, and 2023. Now, using your CPI to calculate the inflation is the same concept, right? So for 2022, so remember 100, so there's no price change in 2021. So CPI, inflation for 2022 is just going to be based on new minus old. Remember the new minus old concept? So new CPI, so the new CPI for 2022 is 114.3 minus 100 divided by 100, which is your old CPI value, times 100. And that's going to give you an inflation rate of 14.3%. Same thing for inflation in 2023. The new CPI is going to be 128.6 minus 114.3 divided by 114.3 times 100, and that's going to give you an inflation of 12.5%. So that is the two approaches to calculating inflation using your CPI or your GDP deflator, which there is something called net national product. So you know how we talked about GDP, GNP. Now, when you're talking about the net national product, that is referring to so net national product is going to be GNP, accounting for depreciation, okay? And that is that about chapter 11, how to calculate your living cost in terms of the purchasing power of a good, whenever there is inflation or deflation.